Welcome. Today's classroom topic is Golden Rules of Accounting. We will learn how to pass journal entry, how to decide debit and credit for any transactions. To understand the Golden Rules of Accounting, we will first understand the types of accounts. Basically, there are three types of accounts, namely, real accounts, nominal accounts and personal accounts. Real accounts covers all the accounts related to firm's assets. It includes both tangible real account, such as cash account, building account, furniture account, investment account, etc. It also includes intangible real account, such as goodwill account, patent account, intellectual property account. Nominal accounts are fictitious accounts that are associated with expenses, losses, revenues and gains of the firm, such as rent and rates account, traveling expenses account, the commission received account, interest paid account. Personal accounts are accounts that deals with persons, that is human beings and artificial judicial persons. Such person includes companies, government organizations etc. For example debtors, creditors, club, charitable trust, company, banks etc. Even there are representational personal accounts like capital account, drawings account, prepaid account, outstanding liability account. Before we understand the golden rules of accounting, we must know double entry system of accounting. Double entry system of accounting assumes that for every debit there is credit. First step to pass journal entry is identify main accounts for given transactions. Then determine nature of account, that is personal, real and nominal. In one journal entry there can be more than two accounts involved, but minimum two accounts are always involved in journal entry. Entry is normally presented as below: Account 1 debit and corresponding amount, and Account 2 credit with corresponding amount. For personal account, golden rule is to debit the receive and credit the giver. Let's see one example. Mr. X sells goods to Mr. Y for 50,000 rupees. Then how we will record it in Mr. X books? In Mr. X books, personal account of Y will be opened. Since Y has received goods, we will debit Mr. Y with 50,000 rupees. Since we have debited one account, we will credit another account, which is sale of goods. For real accounts, golden rule is debit what comes in, credit what goes out. Mr. X started business with 20,000 rupees. How we will record transactions in books of Mr. X? In this example, cash is real account. Since cash comes in business, debit what comes in. Hence we will record this transaction as debit cash account with 20,000 rupees, and since we debited cash account, we have credited corresponding account of capital with same amount. We have already learnt golden rule for personal account. Capital account is personal account. So instead of saying corresponding account, we can say credit the giver. Hence credit capital account. For nominal accounts, golden rule is debit all expenses and losses, credit all incomes and gains. Mr. X purchased good of 20,000 rupees from Mr. Y. How we will record transactions in books of Mr. X? There are two accounts involved here. Purchase of goods is nominal account and Mr. Y is personal account. Since purchase of goods is expense, we will debit purchase account with 20,000 rupees. Since Y has given goods, we will credit person account.